Today, we have a special guest. His name is Ibrahim, and he's trying to retire early. Please, please, please watch all of this episode at the end. I know that this topic is super dry and boring, but if you're able to learn all of these concepts and apply all of these strategies that we will be covering here, you will be well off and you will be all set and retire early. So, dale.
And I like to double my energy, just like a freaking Super Saiyan God, man. Come on, you gotta get better, right?
Okay, Goku, Black Goku.
I don't know, man. He was evil, bro. No, I'm just kidding.
Last time we were looking into different variables to be able to understand all of these financial terms. I really think that sometimes the financial bros, they try to make it so complicated. And so I did wanted to ask you if you can maybe articulate for the audience why you are doing this, why you are asking me to kind of help you and guide you through this process. What are your goals or what is your objective of all this?
So, I mean, it's very simple. When you are dealing with finances, if you're not careful, you can ruin yourself and find yourself, just like you said, at the age of 65 and working. When recently, as I was reading one of the quotes on like the psychology of money, it says it's not about the bigger paycheck that actually builds your wealth. It's how you save. Basically, how much you retain is what builds your wealth. And just like you said the last time, I want to double my wealth, just like everybody else. Who doesn't want that? So I would very much, I'm doing these sessions. So number one, I could learn to be financially educated. Number two, be able to produce income when I'm sleeping, because just like you say, money is energy. And I like to double my energy, just like a freaking Super Saiyan God, man. Come on, you gotta get better, right?
Okay, Goku, Black Goku.
I don't know, oh man, he was evil, bro. No, I'm just kidding. But yeah, that's the beauty of this. You want to learn, and knowledge is priceless. And who knows, I might be able to pass it to 25 other people, along also with my kids as well. So that's why we're doing this.
For me, it was very important. Like when my dad lost his job, it was crucial. That's almost like 15 years ago. Oh crap, he still has to work, you know. And in that time, that's when I realized I need to pay attention on my financial education, because when you're in your 30s, you know, you're like almost in your prime, right? You're thinking, oh yeah, you know.
Yeah, I can do
But you're
this
not.
forever.
Yes, yes. And the reality is that it's not. It's actually when you have to start to capitalize all of what you have learned. And I think that you're in a good stage. I did put together another set of slides. So let me just share with you, unless we go through them. So let me see if you can see my screen. And the other thing that we can do so is basically start moving through. So I think that I very often think this though, like imagine that you're 80, and basically if you're looking back, and you want to realize what did you did with your 30s, right? And I hear a lot of this because this is kind of in the norm. A lot of people in America don't even have 100K, but the people that they are in technology, or they have like they are doctors, or they have some professions, they have around 100K saved. So I feel that people will regret if they don't pay attention to their finances. So I like to kind of almost look at it very like a visual, right? So if you're here, kind of in the middle, let's say that people is 80 years, and at the middle, when you're kind of in your 40s, then, and over here, it took you, obviously, in some point when you start making money, you have 100K, right? Now, if you think about it, we were trying to make the calculation last time. If you are making that money between 100K to 200K, it might take you 10 years to be able to save up to 1 million, right? So the idea is how we will be able to do these jumps to be able to get to 1 million. But I really like to show this picture to people because it is important to visualize, and we will go through the session on how we will have different strategies to be able to jump to that. So let's just recap. Last time I mentioned it to you, the rule of 72. So could you explain it with your own words, if you remember? If not, I can rehash it again.
I can tell you what I remember. The rules of 72 is well, it's kind of in the. Oh, sorry, that's my fridge. but
No worries.
but the easiest way. Oh my God, that's obnoxious. I'm sorry, but there we go. So the easiest way to summarize the rule of 72 is just like you said. Well, let's say that if you are contributing to a savings account with nothing being earned, you'll get to a million. So the rule of 72 can tell you how you actually can double it up within time, but that requires, a certain aspect as well. So that's like kind of like the basic way. So
Yeah.
you can already
So
count it off.
so a way to visualize it is like it's like a snowball effect.
Uh-huh.
So the ball is getting like bigger, right, when it's going down to the hill,
Uh-huh.
and I think that the part that you were saying in the beginning, to be able to while you are sleeping you are making money, that's what is happening. Your money is working for you, and you basically, in the case of gravity, is kind of helping to be able to kind of roll, right? In the case of money, the energy usually is interest. It's usually how it's able to create, to work for you. So this rule, basically, I really like it because it's very simple. So in the case of, if you have 72 divided by 10, is basically in 7.2 years, we will be able to double our money. So why is 10%? Some strategies will be able to give you 5%. Other strategies will be able to give you 10% and so on. Obviously, the higher the better, but sometimes there are more risk. And we will go through the presentation different ways, because how we can try to figure out, okay, what is the type of a strategy for the type of personality that you have. So, and please stop me if you have any questions.
Okay.
All right. Another thing that I need to let you know, obviously, I'm not a financial advisor. I'm your friend. I'm just basically explaining you all of these things. There are people that they are professionals, and they go to some certifications, and the government kind of looks for them and all of that. Have you heard the rule of 220 or 1 and 10?
No, that
Have
one
you heard
is
that?
new to me. That one is new to me.
So these guys, basically, the way that sometimes make money is that they tell you that. They tell you 2 and 20. So basically, they tell you that they're going to get a percentage of your assets. Let's say that if you have $100,000, they will charge you a year 2% of that, and as well 20% of the profits that they make. So sometimes wealthy people really like to do that because they don't want to manage anything. So I don't know. In my perspective, I think that they don't do much unless you have like zero knowledge, right? There is some way for them to be able to kind of get this money, but it seems very pricey for me. Very, very pricey.
Yeah.
There's people obviously that they go ahead.
No, I say 20% of your profit is a little bit too high, and let alone the 2% of your base. It's crazy to me.
It is steep. It is steep. So, and a lot of the things is that they usually have a ratio between bonds and stocks. So, just to recap as well from last time, in your words, what do you understand for a stock? If not, I can mention it to the audience. Could you explain what is the difference between stocks and bonds?
Okay, so bonds is usually issued by the government. That's why they say usually the safest way to get a bond is through like the government. Like you buy it, and then they say within a certain years they can make this much off of it, and then return it to you. So that's kind of like a lot safer than stocks. Now stock is volatile because you're betting, adding more money to a company to say that they are going to do what they're going to do, and you betting on their aka their kind of way of performing. So it would it could go up or down. I mean, it could go down or up. What depends on just what happens. So hence why a lot more traditional people intend to do
So,
bonds because it grows slower.
the
But
let's put it here, the dollar. The dollar is backed up by kind of the governments and their promises. And inside, they call it the bonds. And no wonder why they call it paper bond. It's a type of paper because it's just a promise that they're going to pay. And usually there are like different maturity. I'm going to start sprinkling some words that the finance bros, they like to
yeah,
say.
people like
And I'll try to translate them into our regular terms. the Maturity is nothing more but when they have to pay the interest rates. And most of us, we in America, we understand interest rates because we pay kind of mortgages, we pay the loans for the cars, so
Credit
that's okay for
cards.
us. We are used to that. And you mentioned something about the governments being safe. Depends though.
Yeah.
Would you trust the government of Zimbabwe?
Man, why do you have to bring them here? No, when I'm talking about government and, of course, investing, I'm talking about within America. Uh, in Africa, it works different. You have to invest your hard-earned cold cash, but you own everything about the business. So that's a whole different beast beside that. But we're staying in America, not
Yeah.
Africa or Mexico. We're staying right
Which
here.
I don't know, man. In Mexico, right now is one of the countries that is very stable. Right now, in Mexico, they are paying. That thing called SETE, which is
Uh-huh.
equivalent to a CD in US.
Uh-huh.
Over here, they are paying about 5%, 4 or 5%, and over there they are paying close to 10, 12%.
Oh,
Once
nice.
again, and Mexico is not a country that, yes, is still in development, but it's
Uh-huh.
an emerging market, which is not that bad.
Yeah.
I was telling my sister asked me, she's still over there, lives in Mexico. She was asking me, hey, I have the money to pay my mortgage. What should I do? And that's a good question, right? Like, she has the money. It's like, and but she doesn't know how to calculate these things. Like, what is a better decision? And I
Mm-hmm.
think that personal finances is about to try to understand the numbers behind the decisions. So, and I asked her, well, I don't want to tell you what to do. I want you to kind of make the decision by yourself, and you can figure out if it's a good decision or not. So
Okay.
the first thing, I don't know a lot of the economy over there. I don't follow it too much. Then I asked her, is like, how much is a treasury bond? How much yield they are giving you a year? And she
Mm-hmm.
told me that it's like about 10, 12%. And I asked her, how much is your interest rate on your house, on your mortgage? And she told me that it was about 7%. So then she only basically needed to pay close to maybe 70K, something like that. And
Mm-hmm.
she had the money just to pay it. And I said, well, if you notice the difference is that if you put all of that money in the bank, you're making a little bit more if you're getting it because you have a note. You have the difference between the spread. So one is 7%, right? And the other one is
12%.
12%.
Mm-hmm.
So she will be making a little more money in
Mm-hmm.
this way. So there is a cost of opportunity. And again, some people might say, it's not that much money. I should just pay it off, and that's it. But
Uh-huh.
the other way around is to think, well, when she's getting that, if it's 100K, and you're getting about 12K a month, it's
Mm-hmm.
almost $1,000 a month. It's almost a car,
Yeah.
right?
It's
So
definitely a car payment.
now you see, now this is kind of the way that you can use these variables, even just with regular mundane things. We haven't even touched stocks. I'm
Yeah.
just trying to tell the audience how you can start looking into the interest rates, how the banks are kind of almost tricking you, right? Because it's like refinance, so in that way you can get lower your interest. But guess what? Sometimes you are not making the numbers, and yes, you refinance, but guess what? They might try to move your loan maybe another 10, 20 years, right? So you need to make your numbers in order to figure out the interest rates. So that's an important one. Question so far?
No, no, no. Wow, what did you say? I actually understand very well. So,
Okay.
definitely.
All right. So now let's start moving a little bit more on some of the different strategies, right? So I feel that we have been touching some of the finance and some of the concepts for bonds and stocks, and now we're going to start formulating different strategies. Look, sometimes I hear people just tell me what to buy, and it's like, and that's it. This is a way how the financial advisors they do it. This is an strategy though. I'm not saying that is the best one, but it's a strategy that is super lazy. And basically, from your pie of your money, you subtract your age, and that's basically how much in your portfolio you should have like in stocks. So let's say that you have, how old are you? 35,
35.
30. 35. So that means that 35% of your portfolio should be into stocks and the rest in bonds. Once again, this is just your traditional banking, right, system. And by the way, they're charging you the 1 to 10% or 2%, 20%, the financial advisors to do this. And basically what they're doing is that every year they are rebalancing your portfolio. If the stocks start moving a lot, if it goes outside of that range, they sell a little bit to start having that ratio, always in a 30% as you keep moving. So this is a very simplistic thing in my mind, but once again, they are doing it, right? So I personally like to do a little bit more advanced, so that way I can get extracted more. The previous one though, usually they can give you about maybe in average between 8% to maybe 10% a year. So once again, if you hit 10%, you'll double your money in 7.2 years. Not bad, right? But we're gonna try to improve this with different techniques, right? So now, how do you improve it? Because you're gonna say, well, I don't want to spend all of the money because I don't want to put a lot of the risk on my capital, right? There are different ways though. You can use leverage. So I pulled it out from the dictionary because I think that people, they think that they don't understand it, but they don't, because they don't apply it. And I feel that when people are not applying, maybe they're not understanding it. So let's just look into the finance part, which it says here, the ratio of a company's loan capital debt to a common stock and equity. They make it so complicated, right? But I really, I really like to put the kind of the image, because actually it drives it home. You have without leverage over here. Let me just put it here. You can see that it's just very flat, right? So you will be able to grow, and in your portfolio, if you're seeing your portfolio, it's going to grow very gradually, right? Gradually. But with leverage, I mean, you can have assets like even like Bitcoin, right? Like bananas. And we'll figure out how to control leverage, because leverage can go on both sides. But think about it. I don't remember which mathematician said that. He said, give me a pole that is pretty big enough and I'll move the earth. And what he meant, it was this basically this lever, right? So this lever, with enough strength of the input, then if it's big enough, you might be able to move a bigger boulder and a bigger boulder and a bigger boulder. What that means is that you might be able to keep leveraging. So last time I explained you about most people that they have a mortgage, they are leveraging because they're asking for a loan. So every time that you're asking for a loan, you're leveraging whether you understand it or not.
Okay. Yeah.
So the important thing is to know how much are you leveraging. And I feel that sometimes people are not calculating. They just are trying to get the asset in order to just like buy a house, right? But it's important because sometimes what happened in 2008, it was a miscalculation of bankers and people to over leveraging. Like they thought that houses never will lose their value, and guess what? They lost their value, right? And the bubble popped.
Yep.
So we will keep this in mind, because we will use it later in some of the other strategies. But here's another strategy. This one is a little more interesting. This one it's called the all-weather portfolio. And a lot of these strategies, you can go to like seekingalpha.com and you can start browsing there, or in Reddit, or you can go to Wall Street Bets, right? Be careful. There is a bunch of degenerators over there. Degens. It's like they put everything into an option call, or I should put it like we'll try to see some strategies, but so far right now these ones are kind of the the very vanilla, and there is a lot of different ways for you to break them apart. So in this one is a very interesting. Are you familiar what is an ETF? It spells it out like ETF.
Yeah, I believe so. Uh, yeah, isn't it like kind of like the upgraded version of index funds? And
It is basically that, but maybe this is a good segue to actually show you kind of the some of the indexes. And again, this is a lot of things, and obviously this personal finance we can just take forever, right? But I'm trying just to give you a glance, and that way you can start diving in some of these things. So let me share my screen here. You can go to Yahoo Finance or CNBC. Either one will work. The other one is CNBC. And basically, I like these websites because you can see very quickly kind of the things that people
like the
care.
tickers?
Yeah, but these tickers are the indexes, and over here they will tell you the U.S., EU, Asia, the bonds market, and let's go through them very very quickly. So in that way, the audience, I know that sometimes the audience might not have a full context of all of them. So the first one is called the Dow Jones, and you will see the few letters. Sometimes it's 1 to 4 letters. Sometimes it's just like a letter, and in some cases is 4 letters. These letters are called tickers, and they're important because you can find them on different brokers. If you have never purchased a stock, just go on to Robinhood and download the application, and then you can just start adding some money and then start buying stocks. It's super simple here in America. In other countries, it's a bit more difficult. You want to have interactive brokers or a Charles Schwab account and so on. Let me know in the comments, guys, if anyone is interested to be able to get something else. But yeah, the other one is the S&P 500. This one is kind of the top 500 companies in US. The next one is the Nasdaq, which is basically technology companies. This one is the Russell 2000, which is basically the most important kind of 2000 companies. And the VIX, are you familiar with the VIX?
No, I'm not familiar with the fix.
So the VIX it's an interesting one. Let's click it here. The VIX, they call it the fear index. So this one is an interesting one to tell you how fearful is the market. So and sometimes you see the reference because sometimes there's a lot of information here, but you can start figuring out by yourself. So you just remember that the volatility index, but it's also known as the fear index. And if we just put it all, look at what happened like in 2028. The fear it was high, right? So the number is almost up to 44. And look at it in 2020, right? Like in 2020 also was high over here, probably here. Yeah, here. Here it was almost 53.
3. Whoa.
So, and then look at the standard. Usually the standard is by this line. So this line is about 15, 17. 20 is even okay. It's still in the norm. So right now, what do you think that it is? Like how much fear is in the market?
Like around the norm. Because it's
So even less though. I will even say hitting almost the bottom. Like this is very low. So the market right now is like new administration, Trump is coming, he's gonna save the day. So right now everybody's pumped, right?
wait,
Again,
wait.
I'm following
Last
the
night,
money though. I am
wait.
following the money, and this is what I'm trying to teach you and on others, is that we have to follow the smart money. This is what the smart money thinks because it's the majority of like Wall Street. I'm not saying that they're right, but this is just the reflection of what they think.
Wait, last
What do you
night
think about it?
No, I mean I see it because last night he launched a coin, and it's funny enough that me and my friend and were like looking into it, but we missed it. He launched a coin last night that was 18 cents, and today it's up $30. So technically, if I would have spent $500 buying those 18 cents a coin, I would have made 100K today. So what a
Yeah.
missed opportunity! See. So yeah, so no, speaking of the market, so that like right there what reflected it on a crypto. So
Yep.
I'm kind of sitting salty right now because of that, but it's
There,
okay.
there is there is no point to be salty because there is always opportunities. Though it's just I'm trying to explain you have to figure out and dissect when you
Hmm.
see these opportunities, right? And you basically have to react. So a good question is, how much would you put, right? Like in percentage wise. Do you remember how much I told you in the money management last time?
35, I have a percent. Well, it's not 35, but like your age, what basically like you're saying. So in my case, it's 35, I have a percent. That's why.
So that no. That means that what you're saying is that you will put 35% in the Trump coin.
No, 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 no. I'm not talking about. Oh yeah, if it is what Trump coin, and I would have, knowing it at the beginning, and I see that it was 18 cents, I would probably put like, I would be okay with 800 to $1,000. That would not to hurt me one bit at
Yeah.
all.
So and last time we explore kind of each person has their measuring stick,
Yeah, so
like
I like the trifecta.
yeah, and when it's gonna start hurting you, and you just said like that wouldn't hurt me. I will not lose like sleep, if that thing goes to zero, right? So
Yeah,
some investments are like that, like the Trump coin, and maybe that coin, if it was already X amount of times, you said that it was in 18 cents and then it went to $30.
yeah. Today it was 18 cents last night at 8 p.m. Okay, I look it up, and then
Yeah.
today it's like the last time I checked, it was $30 a coin.
Yeah. So let's see how is this. Uh, 18 cents. So it went, yeah, 166 times.
Yep.
So in just a couple days, which I'm telling you,
No,
there are
in one day. In
opportunities
one day.
in one day. So
Yeah.
there are opportunities all over the place, right? So, but yeah, coming back to the fear index, it's never 100%. All of these are not rules. They're just kind of things to guide you through making decisions.
Hmm.
And I usually don't trade in Europe. Don't care. I'm in America. I kind of understand better this area over here. But again, there's markets people understand Europe and understand Asia. So be my guest. And for me, bonds. If you notice here the maturity, usually tells you that the maturity is 10 years.
Hmm.
And what is the percentage that they are planning to pay? Like I told you, this
Wow,
is like 4 points.
4.61%. Yeah.
Uh-huh. And then obviously the world still kind of runs on oil.
Oh yeah.
The barrel is 78, and if you can see through time, so let's click this guy because it's also interesting how in the economy sometimes I don't know why this guy. Okay, the crude oil. Look, we put it here maybe all time, if not sure how much. And look, it's very cyclical. The
Yeah.
max has been 100, I guess, and $40 per barrel, and the bottom it was is in this time
About twenty
$20.
dollars a barrel.
I personally think that with the inflation in the way that we're going, it might continue to go up. But we'll see the new administration. That's something that we have to pay attention from the economy. But yeah,
Okay.
so let's go back. And we have the gold. That's another important one. People still there are some traders that they call them the gold box because they
Uh-huh.
just like to stash gold.
Uh-huh.
And you have silver, that's the other one, right? And so on. So there are some commodities.
Yes,
And then you
sir.
have the crypto market, which in this case, crypto is there, like a Bitcoin, uh, Ethereum, Solana, Dogecoin, and XRP. So I like to see kind of this in that way. It gives you an idea when you are trying to invest. So now with all of these, let me just go back to the slides. But so far, do you have any questions?
No, I understand actually everything, so that's good.
Cool. So let me go back here. So now that we kind of knew some of these things, now we can start understanding the finance bros. The first one, the TLT, is nothing but basically an ETF that represents the bond market. So when you are buying in Robinhood or in your broker, you can just punch the letters TLT, and then you're buying US bonds. Because I think that's a lot of people, they don't know how to execute. They learn these concepts like, well, I don't know what to do now. Right?
Yeah.
But if you want to execute this with the previous, with the one that we were mentioning about the bonds with your time and your age, let me see. I think that we have it over here, right? So this one, where we have it. I think that way, this one. So we were saying about your age. Hey, maybe you can buy 65% bonds. So that means that you could buy 65% of your capital in TLT. So you will divide, if you have 100,000, you put 65,000 in TLT, and then you will put 35,000 in a SPY. So that was the strategy. Strategy number one. Strategy number two is this one, which you divide your money into bonds, into stocks, and this one is another set of bonds, but with a smaller maturity. So basically more intermediate maturity, sometimes 3 years or so on, because they will be able to pay you a little bit more, on 15%, and then you put in gold, 7.5%, and in the rest of the commodities like oil, silver, and so on, 7.5. This portfolio, it has been behaving very good for the last 100 years. This guy's, which is Ray Dalio, he is the CEO of one of the companies, almost like the banker of governments. And he disclosed this portfolio a few years back. I think that he is old, and he's like, hey, you know what? Let me give this present to humanity.
Let me
And
give
it's
something
just
back to humanity. Okay.
and it's called the all-weather portfolio. So I think that for people that they don't want to mess with stocks, they don't want to keep learning, and they just want to just set it and forget it, this is kind of, in my opinion, a very easy to do it. You just have to maybe do a couple transactions a year. So you do right now that is January, just do it. Then you just, if you want to keep buying, you just at the end of the year, you start rebalancing, or maybe in the middle of the year, whenever you want, just start rebalancing. And what do I mean with rebalancing? Is to try to keep that threshold on the percentages of each, because sometimes they might move. Maybe stocks, like if you remember last year, let me just stop sharing this. We can go to, let me share my screen. So if we go to maybe United States, the SPY. So last year, it was almost, right now, obviously there's going to be a lot of percentage because it's just this year. But 1 year ago, let's see if we can see here, it was about 25%, if I remember, for SPY. So in 1 year, it grew 25%. Then obviously those adjustments on the portfolio, it will make a big difference. So, so far.
Oh yeah, so far so good. Yeah.
Okay, and let's go to here. Let's go back to this. So, all right. So now we have this kind of this strategy. So let's move. It's very important though to also remember the risk. There was this guy, not sure if it was Buffett or Charlie Munger, one of those two. They say certain rules on investing. The number one, do you know what is his rule number one? Have you heard that?
His rule? Okay, number one.
Don't lose money.
Oh, of course. Nobody likes lose money.
All right. So rule number two,
What's rule number two? You gotta
don't
win.
lose. Basically, the first one, just don't lose money. So I think that that is crucial. But if you don't invest, then you will not make money, which is a conundrum, right? In this this one is an interesting chart because you can see almost 100 years there to from from 1960, right? The bull markets and how much they have grown, and the bear markets. All of the ones that you see in the bottom are the bear markets. Different things that happen in the 70s, in the 80s, in the 2000s, and the 10s. I feel that we are not yet at the moment like 2000s, almost like a bubble. But if you see the pictures, like we are
Yeah,
approaching
2000
very,
was definitely high when it comes to a bull market.
yeah.
Extremely.
So it's a word of caution here, right? Like it nobody knows. Whoever tells you that they know, they are straight lying to you. Nobody has a crystal ball, right, to figure out what is going on. But then problem also is if you don't invest, you will be in the silence. So then what do you do? Like yeah,
Yeah, you take risk, but like you have to mitigate your risk to make sure that, as rule number one say, you don't lose money. Or actually, if you're losing, it's very minimal.
yes. So I like to pair it with this because this guy was in the 1800s. I have no idea why he was able to kind
Predict.
of predict, right, in these cycles. We touched base last time, but it's interesting to kind of see it, right? So in that way, it just gives us an idea on the next cycles where maybe my hit. And again, we are in kind of in this area where probably by 2026, 2027 might be some of the bear markets. So now let's go into options. Options are a bit complex, but I'll try to summarize them. So this is kind of the finance bro type of a thing, right? Like, what is an option? Options are contracts that gives the investors the right to buy or sell an asset on a specific price within a set time. Options are a type of financial instrument known as derivative, which means that they divide the value in another asset. Like a bunch of jargon, man.
Bunch of jargons, honestly.
Yeah, how would you describe it? Have you done options before or not? Not yet.
I have been reading about them, but as you said, the definition is just like okay.
Yeah.
But think of it as this: the contract, or like I think of it, every time that you get a contract act with somebody, it's worth a certain amount. In this case, is if I'm doing the like if I like the option is a contract, so there's call and put. So it just depends what you want to do because call option, I believe that's a contract that you buy, and then when you buy it, you set a certain price, and then there's something called struck price. Now with the struck price, that means like the kind of like small little the thing that you're gonna get at a small little thing that you're gonna get for each share, and like for example, let's say let's use Yahoo. I see that Yahoo's stock is let's say $35, and I say okay, gonna I'm gonna go to put now. So I say I'm putting an option to say that Yahoo is gonna go to $37, and I'm selling this contract to sell my stocks at $37 with 80%, no, with 80 cents, like each share, for example. So now when somebody buy that, that's they just bought the contract from me. I was the one who had to put. Okay, I was the one who did the put, means the put option, and then the guy bought the call option from me. So when Yahoo goes to like 37, I made $2 a share, and plus the 80 cents each share for the, you know, for the contract that I put in. But if Yahoo goes higher than 37, I only I have to sell it at 37. That's the one limit that I set. So that's on me. And each of those also have a time limit. Otherwise, it becomes worthless. That's
Yep.
because like you can set the
I can
timing.
I
So
can
yes,
tell that you
something
have been
like that.
studying. Yeah, I can tell that you have been studying. But let me rehash some concepts for you and for the audience, so that way we start building on top of that. So
Okay.
there something that very important to remember is that this thing is they are equivalent to 100 stocks.
Oh
One
yeah,
is
that's
equal
true.
one contract. That's key. So um, that means that if you don't have the money to be able to buy, let me see how much is Tesla right now, 400 and something. If you don't have the $400 to buy like 100 shares, so of $40,000, whatever, then you can buy one contract. So, but the thing when you buy the contract is that is you have to understand the concepts, right? So let's start with the call. The best way that I explain people what is a call, it is a coupon. It is just a
Yeah,
coupon.
that's
So,
true.
so if you understand a coupon, then you understand a call. But because imagine if why people buy coupons, because basically the price is lower, right? So if I'm giving you, tell me a place that you go very often,
Oh, jeez. Place that I
a
go very
restaurant,
often. Oh, that's Brazilian steakhouse. Don't judge me.
which is
Well, foco de chao, for
all
example.
right. Imagine if and how much is like a dinner, $100, $200.
I would say now they actually put it into $60 per person. 60.
All right. So if I give you if I say I'm gonna sell you a coupon that for the next 6 months, your dinner is gonna cost you, I don't know, instead of $60, it's gonna cost you $40. Would you buy it?
Yeah, because I'm
Right?
saving money there. Right? Of course, it makes sense. No.
Some people won't, and that's the reason why it's important to understand these terms because when you see the opportunities, you can say, "Oh, holy shit, this thing is pretty good." So,
Yeah.
and basically, that's what a call is, a coupon, right?
Yeah.
And I think that once again, I feel that all of these terms people understand them. We don't have to rehash them a lot, and I'll explain with how we will translate that into the how to read the charts and how to read some of these things. But now the difference with the put, also people understand it. It's just they have these weird names. A put is nothing but an insurance. Like it's very likely if you're in US, you have a car insurance, right?
True. Oh my God. That thing.
So there is this thing that how often do you pay your insurance? Do you pay it a monthly or do you pay it a year?
No, I try to do a full year always.
So that price that you're paying is a premium. You have to pay a premium, and those words sometimes translate in the option contracts. So that premium it basically is your policy. It's like how much is gonna be your policy to be insured. So, do you remember the price of your insurance?
Not necessarily because I paid it, ate it back in September, so
That's fine.
it's not until
So
next
so
September.
if it's on between
It's
50
about
to 100.
it's no because I'm paying for two cars, so
All
it's
right.
about I think
Two.
like 2.2 to 2.5K.
All right.
It's
So
actually in that range.
all right. Perfect. Because at the end of the day, that's what is happening. You are paying $2,200 a year to be able to be insured for the whole year if something happens to your car. If somebody steals it, if somebody hits, or if you are hitting someone. So, but what is happening there is that you are moving risk. You are willing to pay. In the case of America, we cannot get forced to get an insurance. In other countries don't, but it is basically these instruments. They help you to understand other concepts, and that's basically very similar to a put. A put is protection that a stock price is if it hits that you only pay a specific amount, and just with those two you are able to build a lot of different strategies. So let me just share again my screen, and we're gonna start looking at something and some other terms. Okay. So the way that I got here is just I literally kind of put the option chain, right? I just type option chain and I got here to this. So you go to Google, oops, and then you just type option chain and then Tesla, right? Or whatever stock you want. And then you just hit here and you start seeing this is from the Nasdaq. And again, very similar. If you go to any broker, it's going to have something very similar, where you have a sets of columns that they are called calls, and then you have the other columns that they are puts. And in the middle of this, you're going to see at the money. What it means is that that's where the price is right now. This thing is fluctuating, obviously, price going up or price going down. By the way, the people that they created the formula to be able to price an option, they won the Nobel Prize. So they won the Nobel Prize for this because they were able to dynamically calculate the price of the option. So you can see some variables here. Last is the last price that it was the ticket, the amount of change, how much is the people bidding. Sometimes it's very hard for people to understand these two words, right? Because sometimes they get confused. But remember that one is for buying, another one is for selling. Somebody's asking for this. The asking price usually is the one that for me is faster to remember. Somebody's asking $20 for this contract, and that's what it means. It means that somebody is willing to sell you this contract for this price, and somebody say nope, I'm not willing to pay. And there is a difference. If you notice, there is a little difference, and that war between this person. I mean, you could be like two people. It's like nope, I'm not gonna buy you that, and it's like, well, I prefer to lose it, right? And then until somebody actually concede, that's when the transaction it happens, right? So, and that's what you kind of see. But yeah, the important things to know is that if the price is there, that means that it's at the money. So, and if it is outside, it's out of the money. So OTM. So you'll see those variables kind of in the broker when they're telling you at the money or outside of the money, and that's what it means.
Okay, so wait, where do you see OTM? Sorry, I didn't mean to cut you off.
Yeah, no. This is good. It's just outside of this price. Any price outside of the price where the stock is moving, it will be out of the money.
Okay.
So, because if we start looking here at the money options, there is a bunch of mathematical formulas to be able to kind of know. Here is a representation, like I'm telling you. If the stock is here, is at the money, and there is in the money, because depending of the calls.
Oh, okay.
An example is that the stock, it already is in 4,000. If you already have a call, it's already in the money. You're already making money, and vice versa, right? If you are in a put, it's outside of the money. But if it's like over here, it's kind of telling you. And again, there is multiple ways to create it. There is a lot of strategies though for options, because people think that in a stock market you only can make money when the stock goes up, but no. I mean, you can short it too, so you can make money going up and going down. And that's if you buy and basically short it. But in options, you can even make money if the stock doesn't even move.
But that's true.
You can bracket the option. So I'll throw some names there, but I want you first to internalize some of these. But basically, you have an iron. It's called iron condor, and basically you bracket it. You create a bunch of legs. Basically, you will have to have two contracts, one in one side and on the other side. And as long as the stock is within this range, you'll make money.
Oh, in math, it's called, well, if you have a range, basically like you're putting two contracts, and then so those two have a range in between, let's say $14.90 to $20. So if it fails anything above that price, you make money. Okay.
And basically these ones, they call them legs. So it's just lingo that they use. It's like this has these different legs, has 2 legs or 4 legs. There is also a butterfly, options, butterfly. That's the other one, right? So you construct it, and sometimes these images help to visualize it. Some brokers, it will show you a picture of how your stocks, so that way you can see the price, where you can get it or not. And I would recommend people to not start with these ones because these ones are a little bit more advanced. We will cover a strategy over here, but another one that is basically a spread, bull spread.
Bull spread.
Options, okay. Strategy, options. It's only you buy 2 contracts and then you're moving in. If your perspective is bullish or your perspective is bearish, you can buy the spread. And basically, this will allow you to protect your downside. So, because one contract it will actually limit it, and the other one will gain it. So you can figure it out. But again, I'm just throwing you some names for you to be able to kind of start learning. But we will maybe rehash that in a different session. Right. But I just wanted to let you know there is many ways to leverage it. But going back to the other presentation, this one. These are the important things, right? That each contract is equivalent to 100 stocks, which basically you're leveraging. You're leveraging 100 times. Now, do you see why it's important to know leverage?
Yes, it is, definitely.
So now that we know this, there's another way to do it in a very simple way. So tell me a stock that you like. Doesn't matter. Right now, I'm not going to judge you on your preferences.
I like tech a lot. So let's say, let's go with our Tesla, because I do actually like Elon.
So basically, right now you like Tesla, right? So one strategy, let's just basically with everything that we learned today is strategy number 1 is just buy the stock, right? Mm-hmm. All right. So strategy number 2, what is the second strategy? How you can leverage this?
You can do call options, for example.
Mm-hmm. But then that one is basically the strategy that I want to cover right now, which is a cover call.
Yeah, a cover call. Yes.
So basically, right now, let's say that you already purchased Tesla and you believe in Elon Musk and you're like, this guy is going to become a trillionaire. I'm going to bet my share on him. So but I want to start making more money because right now you keep the money on the stock. And let's say that you already have your capital to be able to buy 100 shares.
Which is $40,000 in this case, let's say.
So you have $40,000. You already have the share. So you can do this thing called a cover call. And what is happening with the cover call is that you are selling one contract to somebody in the market. You are willing to sell that contract. And what you're telling is like you're willing to do a coupon. If the price of Tesla goes into specific strike price, you will be able to get the premium. And let's actually do a real numbers here because we have it here. We actually pull it out. So this is the option chain. Right now the price is 426, and we have to decide by when. So all of this is the expiration. So this is the expiration. You can even go some stocks it might allow you to do 1 year or even sometimes farther. So you have to see. But basically what you're saying is that this site is the calls. So if you are willing to sell, let's say that you are willing to sell by the end of the month, one contract is $14. And remember that this is multiplied by 100. So you will get for one contract $1,400 if the price will remain 48. So what happens if the price goes to $49 or $50?
You still lose because you have to honor the contract that you sign and say that you will sell your stocks regardless of how high it goes, and you set that price yourself to be $48. So
are you sure that you're losing though?
No, you're
because
not technically. Well, yeah, you're losing on the gain aspect, but you still made money. But
yes,
you basically limited your potential.
yes, you cap it your potential. But I wanted to explain people that sometimes it's okay, right? Like you already made money. It's like at the end of the day, let's say that you purchased Tesla 3 years ago. Right now, what you're trying to do is to keep reducing your cost average of your Tesla stocks, and this is a good way to. This way also is to be able to create some income as well in a monthly basis with the investment that you already have, right? This strategy is very simple but very very powerful in my opinion, because you already have the money there invested, and then the worst thing that could happen is that you sell it at that point, because what the contract is going to force you is to sell your Tesla stock at that point.
Yeah.
But guess what? You can rebuy it, right? Like if you truly still believe in Tesla, just rebuy it at that price and move on, right? And you could keep rinsing and repeating. I think that the problem is that people put themselves in trouble when they over leverage and they don't have the stock, and now they have to they call them naked options, and that's where once again they get in trouble. But yeah, that's kind of the different options, and hopefully that gives you an idea.
Options,
What do
yeah.
you
We
think?
covered calls, put, and cover call.
What
Right.
questions do you have?
As I think I made a mistake on almost touching well, cover call, or by saying if I put the contract, so that was a cover call. But interesting, yeah. As far as I know so far, I don't have any questions because I have to rewatch everything just to take notes.
Yeah, and I recommend you to start playing. You can buy some call options, and you can be in the two sides of the equation. If you buy the options, you are buying a coupon, but the time is against your favor, right?
Yeah.
The other way around, when you are selling the options, like you will be like the insurance company. You are the risk. You're absorbing the risk. Like the insurance company, they are making money because there's a lot of people buying these contracts. But in some point when there is something happen like in Cali, that a lot of people happen, they
Yeah.
just go under because there's a
Yeah.
lot of disasters, right?
So they have to
So,
pay quite a lot, and
so
that's
I think that
usually what's
my
happening.
recommendation right now is to risk what you have, but it's very low risk in my opinion, because if you already are invested in these companies that you are there, as might as well start extracting some extra cash. I have seen people getting, I don't know, 10% a month. Sometimes it's not consistent, right? Because the market keeps fluctuating. And the thing that you need to keep looking is that volatility is key. So in that way, when the market is moving, um, the stock price and the stock option will fluctuate a lot. So, but yeah, I feel that just, and the other thing that you can do is to do paper trail. Like you can just paper trading and see how the contracts are
That's what I was
behaving.
gonna ask you because I would very much like to start about playing with paper trails first before I start doing these things. As I say, you got to learn how to walk before you can jump into.
Sometimes, but it's not the same though. I'll tell you this. When I started learning, I just buy one contract or sell one contract, and just with that, I was able to see how it behaved, because it's funny. Sometimes you might not be able to see how they move because in the paper trading, it doesn't move quite the same. What I mean is like the prices doesn't fluctuate because it's, yes, they have some history, but it's different. I think that in some point very quickly you'll notice that you have to do it in real time.
Yeah, of course.
But yeah, the one that I use though, I will recommend you if you want to start using. It's called Tasty Trade. Yes, let me use here. They are not super cheap, but I feel that they have. Let me just put my window here. This company, because it's very visual. Yeah, it's very very visual. Their fees are like, not that bad. They're like in the price. It's $1 per contract, and when they're closing is a zero. If you want the big boys, is called Interactive Brokers, but their software sucks. Like their UI is like horrendous. Or you can just do Robinhood. Robinhood is mobile. Yeah, obviously they
Yeah.
have a desktop app. But uh, uh, Tasty Trade is not bad. And actually, you might be able to start opening the account and download the software, and they have a way to bracket it, and then you can start playing around to see how the contracts behave.
Okay.
Yeah,
Makes sense.
cool. What else, man?
Yeah. So we cover another session, which is pretty
Yes.
good. And thanks definitely for the knowledge as well.
No problem. So let's catch up the next time, and maybe we can start doing more advanced things. So yeah, I wanted to show it to the audience as well, so that we can learn with you.
Okay. Sounds good. Definitely.
All
Thank
right.
you.
Thank you.